Hey everybody, what is up? Welcome back to Funnel Trade. So I got a question from a patron yesterday about what profit margin is enough and how do I evaluate that when I am buying and selling items for my business? And this is kind of a complicated question and it has a pretty complicated answer. And so I've prepared a chart of data for you and I'm going to talk for a while about it. You have to intelligently allocate your capital with respect to not only return on investment, but the holding period. How long you're going to have your capital tied up in a product, or if you're doing this uh, post facto and you've got an item that you've held for a while and you're trying to decide if it's time to sell it, you would need to measure how long have I held a product. And so this kind of analysis, you can do it forwards or backwards, either way. And when I talk about this stuff, I'm going to talk specifically about return on investment instead of profit margin. And they are kind of subtly different if you're not an accounting type. Return on investment says, well, if I had $100, I then use that $100 to do some business activity. And at the end of that activity, I had $137. We would say that your return on investment was 37% because the $37 of profit is 37% of the capital you initially had. Now, if you're talking about profit margin, then you would say your profit is $37 of profit divided by $137 of revenue, and you would get a different fraction. And so I'm going to be talking about return on investment. So it's the amount of profit as a percentage of the initial capital that you allocated to things. And that works well because whenever I do compound annual growth rate calculations and annual rate of return, I've talked about that a couple of times recently, then you're doing those as a return on investment calculation, not a profit margin. I know sometime I'm guilty of being kind of loosey goosey and using the words profit margin when what I really mean is return on invested capital. So, with that out of the way, you you need to just understand that the answer to this question of what profit is enough is two part. It's a matter of what is your return on investment, but also how long does it take you to get that? And you can imagine a situation where maybe you have some activity where, oh, here's a good example. People always talk about asteroid mining, and they're like, somehow we'll find an asteroid that's solid gold as if it exists. And then they'll bring it back to Earth and they'll make a lot of money. And it's like, yes, I mean, the return on investment on that activity would be very good, but it would take decades to do it. And so, is it actually better than, say, opening a convenience store and selling hot dogs? Let's say, with all the money that I was going to take out and I was going to go start an asteroid mining business, I instead could take that money and open a chain of convenience stores that sells hot dogs. And for that whole time that that mission to get that asteroid is headed out to the asteroid belt, it finds that solid gold asteroid, it slowly nudges its orbit to get it back to Earth. And for all those decades, I'm just selling hot dogs at my chain of convenience stores. And, I'm making 5% turn on every hot dog I sell, and it allows me to scale up the business. It could be that selling hot dogs is a better use of your capital than asteroid mining. And so you have to look at this in business when you're thinking about how am I allocating my capital and am I getting the best return on investment that I can reasonably get? And is this actually better than doing nothing and just liquidating my business and putting it into S&P 500 index ETFs? Okay, so let's go to the chart and I'm going to explain what everything in this chart means. And so what we have along the horizontal axis is holding period measured in weeks. And so I've put it here as in 2 week increments going out to a 1 year holding period. And on the vertical axis, I have return on investment of some activity you're going to be doing in your business, whether this is breaking boxes for singles, uh, hosting Pokemon children's parties at your card store, or it's buying sealed product and letting it sit in a closet and then selling it, whatever the activity is, you have some expected return on investment that you think you can get, and you estimate some period of time it will take you to achieve that. Maybe it's going to take you time to say you're hosting those Pokemon birthday parties and you think you can only book one every 4 weeks. And every 4 weeks you'll do it. But you know what? On the money that you've invested in the ability to do that, you make a 50% return each time. And assuming you could scale up the business infinitely, then you would turn your money around with a 19,000% annualized return. And so, with a mere 4 week turn time and 50% input, yes, your money would multiply 193 times a year. Now, obviously, the problem with that is those kind of opportunities don't really exist in the world. Any place where that kind of opportunity did exist, other people have come in and they've diluted that market with additional competitors who lower prices, who reduce the margins until maybe, every 4 weeks you can host a party, but you only get a 5% return. And so you're at this 89% annualized return on investment. And so, for any of these holding periods on the horizontal axis and a corresponding return on investment on doing this activity one time over that holding period, you will end up with whatever the table shows as your annualized rate of return. Okay? So, I've highlighted in red here everything 15% and under. And the reason for that is in more recent years, the S&P 500 has returned around 15% because inflation has been high. So you get additional returns because of inflation, because there's money pouring into the stock market. So about 15%. So if you're running a business and you're doing an activity and you can't make 15% annualized return by doing those activities, you probably shouldn't spend your time doing it because you're spending time, you're taking on additional risk, and you could just liquidate your business and take all the resulting money, put it into S&P 500 index ETFs and make that 15% while you sit on your butt. And that's probably a better plan. Okay. So recently I said I had done some calculations with final trades numbers and I had come up with an annualized rate of return for final trade since its inception of 70% per year. And so I've gone through and I've just highlighted where is 70% on this chart. And so I can see, well, if I had some other complete business package that I could do instead of final trade, and I thought, okay, maybe it's some really great business and it has, say, 20% returns on investment for every time it does whatever its discrete unit of activity is. Then I could say, well, I need to be able to do that every 14 weeks or faster in order to stay above the yellow line of Final Trade's current performance. And likewise, if you had a complete business package that, you could turnkey do instead of final trade, I might say, well, let's say that I knew it had some product, let's say it was some big capital product that it manufactured, and it took 30 weeks to manufacture the product. Well, every 30 weeks, I could turn around the capital, get a return on investment. And so for it to be better than final trade, I would have to be above the line again, which means I would need returns on investment of each instance of creating that capital item and selling it into the market of 40% or greater. And so you can think about above lines are better and below lines are worse. Okay. So when you're using this, there's a couple of things to think about. Um, you have to decide where your overhead goes when you're doing these calculations of return on investment. So for my specific case right now, Final Trade has virtually no overhead. Okay. I already pay to live in my house. I run the business out of my house. Uh, I don't use any marginal additional electricity for the business. So in terms of overhead costs, Final Trade is just about zero right now. Now, if I get into a store here in the coming months, I'm going to have rent, liability insurance, electricity, internet, and 100 other things, potentially employees at some point, all kinds of other expenses that are overhead. And you have to decide when you do these calculations, are you factoring in your overheads and your business expenses into those calculations of return on invested capital? So I don't do it. And one, I don't factor those in because right now Final Trade really doesn't have any. And two, because I want the cleanest look at what is this activity going to actually yield. Buying these boxes or hosting this Pokemon birthday party or, you know, building this capital asset that you sell into the market, whatever your business is. I want mine when I look at some additional activity, I want it to be clean from the business overhead costs so that I can say, okay, is this something, assuming that the activity itself does not require you to take on significant additional overhead, is this thing better than what I'm already doing? Okay. And so if you want, you can change these calculations when you figure them out yourself to instead of just being, hey, I bought a box for $100, I sold it for 137, and so my return on investment is 37%. Instead of that, you can make the calculations more complex if that's what you need in your business. And that's one of the fundamental lessons of accounting is the rules of accounting are not written in stone. They vary business to business, and you will do things differently depending on the nature of your business when you go to do your accounting. Certain expenses, certain activities are treated differently in different industries, and that's perfectly normal with accounting. So that's the first thing. Uh, is your overhead going into your measurements? Basically, when you're doing your return on investment, is the profit part your gross profit or your net profit? The second thing to think about is, are you losing 25% of your return on investment, the horizontal column? Are you losing 25% of that to taxes? And you need to decide, like, is this something you want to acknowledge here or just not acknowledge it here? And it doesn't matter either way as long as you're conscious of the facts. Okay. Eventually, you have to pay tax on these profits. Yes. And it may be critical for you to think about it post tax because there may be a point in your business where you say, okay, I've made this much money so far this year, and the next box I sell, it's going to bump me up into a higher tax bracket. And every transaction after that is now going to be at, I don't know what the marginal rates are nowadays, 33% instead of 28% or whatever the jumps look like in the tax brackets today. So you can decide whether you should reduce your return on investment percentages by your top marginal tax rate and whether you should take into account, okay, my tax rate steps up at various points of income in the US tax code. So keep that in mind. You may not mess with it. I don't think about that. I get to tax time and I figure out my taxes and I pay them. But during the year when I'm running my business, I'm thinking, oh, this activity has a 20% return on investment. I don't then stop and think, and then I lose 25% of that 20%, which is 5%, to taxes. And thus, the actual post tax return on investment is 15%. I don't bother with that because all of my profits get taxed. They all get added to the same pool and they get taxed at the appropriate marginal rates as you march up your amount of income. So think about that if you need to. Now, the next thing to do when contemplating this problem of when is the profit enough that you want to engage in an activity, it's figuring out what your base opportunity is. And by base opportunity, we talked about one, and that was liquidate your business and go invest it in the S&P 500 and sit on your couch watching SpongeBob every day and you'll make about 15% return on investment. But the other base opportunity to think about is what can you do in your business consistently that you can scale that has a pretty consistent return that goes along to it. So you can do it consistently, meaning you can turn it over again and again on a predictable, repeatable holding period. And then the margins are pretty predictable. And one that worked for a while for me with Final Trade was breaking boxes and selling singles. And up until about mid 2024, when the market for that became a lot more difficult, I was turning a lot of singles. And I got to the point where I was doing like 20 to 25,000 a month in revenue off of single sales on TCG Player, and I was doing it just part-time. And back when I did that, I was getting about 20% return on investment. So every time I would turn around those those cards, I would, order, pay, receive, open, sort, list, sell, and fulfill, and I could blow through most of the cards that I had got in generally about 6 weeks. And so if we come here on the chart and we say, okay, well, I was making about 20% margins, that's how I did my pricing. And the result was that I could turn it around about every 6 weeks. Well, then my annualized return on investment was 386%. So if I started with $100 at the beginning of the year and then I did this all year long, at the end of the year, I would have the original $100 still, and I would have $386 additionally. Okay. So think about what your base case is, because if you have some additional opportunity arise in your business, you're looking out at some product you might buy, you're looking at the next expansion, you have a opportunity to buy out someone's collection, then you need to know what the base case is and what your annualized return on investment of your base case is, because your alternative to doing that new thing in your business is to just go do that base thing more. And so for Final Trade right now, my kind of base case thing is I have a whale that I work with, and he has a supply of product. He gives me a favorable price on it, and then I can take that and sell it into the market. And so I can simply arbitrage from him into the market, and I can make something like 12 to 15% profit off of that. So that's the base case. If I ever have a dollar in my hands as Final Trade, then I can choose to go buy $1 worth of product from him and sell it into the market, and I'll make about $1.12, $1.15 of revenue off of that. So 12 to 15% return on investment. That's the basic activity. So whenever I'm looking at any other activity, I have to believe that the return on it is going to be better than a 15% return turned around as quickly as I can take a random product and sell it into the market. And so maybe we'll say 6 weeks is pretty reasonable, and a 15% return on investment and a 6 week turn time. And so my annualized rate of return on my base case is 236%. And so then when I'm looking at anything else I might do, it better show up on this table as a number higher than 236%. Or I'm just going to take the dollar that I could have spent on that alternative and send it to this whale, buy his product, and just sell it into the market. Okay. So understand what your base case business activity is, what its annualized rate of return is, and then how to look at a table like this and evaluate other things against it. And of course, you can change these numbers here. Here's the formula if you want to understand how this table works, and that's just copied into all the cells. You could set these holding periods. You could just change the numbers to every week. You could change it to, you know, 4, 8, 12, 16 for months. And likewise with the percentages, I set this table up fairly coarse in the numbers so that it reflects the fact that you can't really measure these things very well. When you're looking forward with, should I engage in this business activity? Do I think it's going to be a good thing to do compared to using my money for something else? Often, you can't really guess what the return on investment is going to be with a really high degree of accuracy. And so 5% increments is pretty good. And, 2 week increments on the horizontal axis, yeah, that's probably about as fine as you will be willing to guess. So figure out what your base case is, what the thing is you can normally easily do in your business, and then figure out everything else compared to that. So, if, like I said, maybe 236% annualized return is the base case of each additional dollar, okay, then I would look for approximately that number elsewhere in this chart. And, we'll just highlight some of the numbers near it. And then I would say, okay, well, for an opportunity to be better, it has to land on the chart above that line, not below it. And so it means that, well, you've got to have intersections of return on investment and holding periods somewhere up here. And so it also means if your alternative is something that returns 10%, well, most of the chart is below that line on the 10% row. And so it's going to have to be a 10% return that's very rapid, like 2 or 3 or 4 weeks kind of rapid to be a better than whatever the base case activity in your business is. Now, um, one other thing to think about is, do you personally need to realize the gain in order for this to make sense to you? In order for you to evaluate things on this chart, are you going to think, okay, for me to evaluate a business activity, I will have to conclude the activity, sell off the product, sell off the service, whatever it is, and get cash in my hand? Or is it good enough in a business like this where we hold product and it generally appreciates? Is it good enough that you have a paper gain? And so, if it's okay with you to think of this as legitimate as paper gains and not as realized gains that now you've traded the product for cash, then you can start to think about this in other situations, such as gapping up. And so, I think about it that way. If final trade is sitting on some boxes that have, appreciated some amount, or if I'm doing this as a forward looking activity, some boxes that I believe will appreciate similar to some other historical precedent, then I can say, well, I'm happy to simply be holding those boxes in the future. I don't have to sell them in order for this to count as a useful metric to my business. And again, that's kind of a personal accounting decision you're going to have to make for your business. But it's one of the reasons that I love going out on the marketplace and looking for products that are about to gap up. And so when I see something where, say, one more week of normal purchase sell through rate on TCG Player will cause this product to increase by 20%. Well, you could plug that in on this and see what the annualized rate of return is. And that's why those kind of gapping up situations are pretty powerful to spend your money on. And it's why, for the whole history of Final Trade, I've always labored the point that if you can buy something that's a great price, but also has a gap up pretty soon, that puts you in a much better position and much more likely to profit off of it and profit greatly off of it in the future. So, now, what are the problems with this kind of method? Okay. Um, Biggest problem is the world is limited. Obviously, you cannot do some activity that has an annualized return on investment of 10,000% and do it forever. You will soak the market. You will also run into other problems where, let's say, the market to purchase the product is not that big, but also not enough product exists. So you will have to diversify your business into other things. And that's why, personally, I have several pipelines of products, of types of products, of ways of selling, things like that. So I've got Magic and Pokemon and Flesh and Blood that I purchase and put back in the closet. But then I also have a patron program, the sealed sales, the monthly sales list, private deals. Very rarely still I sell out on the open market. I've been doing a lot less of that in the last 6 months, but I have a lot of different ways that I can move the product so that I can try to get as close as possible to doing things as often as I can to keep my money busy. Okay. But you will always run into a problem of soaking the market at some point. So that's why you can't simply say, oh, well, the chart says that it's a 10x every year, you'll 10x your money. Okay, well, yeah, maybe you can do that 1 year, maybe two, possibly three, depending on where you're starting from. But after that, it's going to become increasingly hard to 10x the profit that you make off of a single activity in your business year after year after year. Okay. So that's one of the things to keep in mind, that it's not just infinite. Okay. It's not the infinite money glitch. So you're limited by reality. You have to have multiple pipelines in order to try and uh, get as many of these opportunities as you can. The idea of filling the pipelines up with product is something I talk with my patrons about a lot. That, I started the monthly sales list, and most of the things on there in the early days, I might have 4 or 5 or 6 boxes. I had very, very small inventories, and it's built to the point now sometimes I'll add stuff to the monthly list and I'll have 20 or 30 or 40 boxes of it when I put it on the list, but it takes time to build that up and to get it moving. Um, you also have the problem of outside events screwing up the predictions that you make with spreadsheets. And the world and markets and sell buyers and everything else are a lot more complicated than just numbers on a spreadsheet. You're going to have bear markets. You're going to have products that do a lot more poorly than you expected. You're going to have products that don't turn as fast as you thought they could. And so it's another place where maybe you don't want to sink everything into a single bet that you think is going to have an ultra high compounding return. You instead spread it around. You even spread it into things that you think don't have nearly as good compounding returns because they give you a little more variability, a little more spread out of the risk, and protect you a little better. So, you know, flip side of that is the opposite of risk is opportunity. And sometimes you'll evaluate some product. You'll say, okay, well, I think I can turn it around in 3 weeks. I think the profit margin will be this. And everything goes better than you think. And you have those opportunities. So sometimes you do get lucky, but you just need to be sober with yourself about the fact that your predictions can be wrong. So, um, spread the risk by having more products, more avenues to sell through, and things like that. So now I'm going to tell you the cruel secret of all of this. Now that we're a half hour into this, I'll do like Rudy, where I say, everyone else has clicked off and I will tell you the secret. So let's think about Rudy and how he runs his business. Okay. He does sales to his patrons 4 nights a week, and he's been on a 4 night a week schedule for a couple of years now. I remember back in 2020, 21, he was on more of a 1 to 2 or maybe 3 night a week schedule. But imagine you're Rudy. Imagine you have some amount of capital and you use that capital to buy boxes from distribution, and then you sell them to your patrons, and your turn time is pretty quick. Really, you have a bunch of separate little piles of capital, and each one is turning kind of quickly. You're turning one every couple of days. A different one of these piles is turning around. So let's say that Rudy could do 4 sales a week, and let's say he was a machine. He never took a break, so he did 52 weeks a year of 4 sales a week. And let's say he turned a mere 2% return on investment on every one of those sales. What is his yearly annualized return on investment? It's 61x. And so if he started with a pile of money at the beginning of the year, by the end of the year of doing 4 sales a week at 2% return on investment on every sale, he would have 61 additional piles of money and his original one pile also. Now, obviously, Rudy runs into similar problems. The world cannot sustain a business that is growing 61x per year because, and I actually did the math on it, Rudy would go from a one man operation to employing everyone on the planet in 6 years at that rate. And additionally, he would have to have everyone on the planet as a customer. He would have to have more magic product than exists. So obviously, that put a cap on how his business could grow. But that was the secret of his business. And when I first got turned on to Rudy in 2020 and started watching his videos, after a couple of months, I realized that's what his business was. He had a captive market through Patreon of people who were willing to spend a lot of money, and he could do quick turns to them of capital. And it didn't matter. And back then, during a bear market of 21, 22, etc., most of his sales were much closer to that wholesale cost. It's not like today when we're in a bull market and hey, his patrons will pay whatever 140 for an Edge of Eternity's play box that he bought for 93. More power to him if he's selling every box he can in an hour. I don't hate the guy because of it. More power to him. But even back then in 2020, 21, 22, when most of his prices were much closer to wholesale prices, I realized he's out there just attempting to make 2, 3, 4, 5% per sale, 1, 2, 3 sales per week again and again. And I did that math and I said, that's a hell of a way to compound your money really, really fast. And then I said, what if I could build the same business? And so, one last thing, uh, I have a my best friend from childhood, and he loves magic. We've always loved magic, and he's a business owner also. And so, I talk with him about the inner workings of Final Trade a lot, and some of my crazier ideas. And one thing that I say to him commonly is that I look out at the TCG market. This is something I would only put at the very end of a video where 2/3 of people have clicked off already. I look out at the TCG market even today and I see free money everywhere. I see money just sitting on the ground that nobody is picking up. And the reason they're not picking it up is because they have other business opportunities that all of their capital is tied up in right now. And so I see those uncaptured opportunities out there and I think, okay, I need more capital. And so, I've engaged other investors who partner with Final Trade and they provide capital. I use free credit to the small extent that I can to get extra capital. But you always have to remember, even when you're seeing opportunities out there where it looks like, hey, there's an opportunity for a 50% gain. I bet I could turn that around in 6 months tops. It still may not be good enough to compete with whatever your base business activity is. So keep that in mind when you see things out there that appear, hey, I think I could buy that product and in six months I could turn it around 20, 40, 80, 100% profit. Keep in mind that you have to compare it to your base case of what else you could do with your money in your business. And always, always be sober with yourself about what are the real returns that I can expect to get off of this and how long will it realistically take? Because if you use a bunch of rosy, over optimistic numbers, then your calculations are going to be off and you won't be making the best choices for your business. So hopefully 34 minutes is a verbose enough answer to this question. I think I pretty much got out everything I wanted to say about it. Hopefully it makes sense to the patron who asked the question. Ask me follow-ups over on Patreon. And if we need to, we'll have another video. Everybody go look down below in the description, buy a hat, $25. If you are not a patron, patrons get them for 20 bucks if you buy them while you're buying sealed product. Let me know what you think, guys. Thanks to everyone who makes this content possible, especially my very generous supporters on Patreon. Like, comment, share, and subscribe, and join me on Final Trade.